Hi, welcome to this short video on essential business terms for the McKinsey PST. As McKinsey indicates on their website, the PST doesn't test your business knowledge as such. However, we felt that knowing some basic business jargon can make you a lot more comfortable reading through the case descriptions in the test and therefore increase your speed. So let's go through a few of the main concepts in business. The first thing that you might want to know about a business that you're analyzing is how much revenue they make. That is, how much money they receive from their customers. If your company is selling shoes, for example, then your revenue is all the money that customers have paid you in exchange for shoes. There are two ways to calculate revenues for a business, depending on the information you're given. You can be told how many items a company sells, the volume, and at what price the company sells these products. Revenue is then given by volume times price. Sometimes, however, you will not have information on the price and volume, but on the total sales that the market generates in a specific industry. If your company sells shoes, then total market sales is the total amount of money that shoes are sold for across all companies in the world. The market share of your company is the proportion of its total market revenues generated by your company. So revenues can be calculated as market share times total market sales. Let's look at an example to make all of this more concrete. You have probably already looked at the sample test provided by McKinsey. In question 23 of sample test B, you are asked to calculate profits given market share, total market size, and profit margins. We will come back to the definition of profits and profit margins later. For the moment, suppose all you want to do is to calculate the sales of Pharmaco in country 3. You are told that the total market sales in country 3 are $1.2 billion. And you can see from the graph that Pharmaco's market share in country 3 is around 3%. Using the formula above, you can get directly that Pharmaco's revenues are 3% times 1.2 billion, which is equal to 36 million. The next term we want to discuss is cost. Costs represent all the money that the company has to pay to its suppliers. Running a business requires quite a few different expenses. The raw material of the product you sell, the wages of your employees, energy supplies, transportation, and many other costs. Because there are so many different types of costs, it is useful to break them down into different categories. Variable costs are those costs that change with the level of activity of your company. Fixed costs, on the other hand, are the costs that would have to be paid regardless of how much is produced. For instance, things like raw material are variable costs. If you stop production, you won't need to buy more raw material. Transportation is another type of variable cost. Fixed costs will include things like the cost of your building or the salary of your CEO. Another way to classify costs is to break them down between cost of goods sold and overheads. Cost of goods sold represent costs that the company can attribute to a particular item they sell, while overheads are just costs that cannot be allocated to a particular item. Again, if your company makes shoes, then raw material, manufacturing costs, transportation and storage will all be included in COGS, while the cost of a marketing campaign, the cost of employees operating the store, or your salary as a CEO are overheads. Finally, costs could also be broken down into labor and non-labor costs. This is pretty straightforward. Labor costs are the expenses related to the people your company employs. Note that these distinctions are not always clear-cut. The difference between variable and fixed costs will depend on the time frame that you are looking at. In addition, some labor costs may be variable or fixed, as I suggested. In a PST, the distinctions will always be made clear. Let's finally turn to maybe the most important business performance measure, profits. Profits represent the money left to the owners or managers of the business after all expenses have been paid. Like sales and costs, they represent a flow of money, so they are calculated over a certain period of time, like a quarter or a year, for instance. You can calculate profits in one of the following two manners. By definition, profits is equal to revenues minus costs. That is, all the revenues that we calculated earlier, minus the variable costs, and minus the fixed cost. Alternatively, you might be given the company's revenues and its profit margin. Profit margin is profit per sale. Therefore, profits can be calculated as revenues times profit margin. Again, we can illustrate this with the example from question 23 in sample test B. We calculated earlier that Pharmaca's revenue in country 3 were equal to 36 million. You can see from the graph that the profit margin in country 3 is around 35%. Therefore, you can calculate profit as 36 million times 35%, which is equal to 12.6 million. In the last part of this video, we will go over a few ratios and metrics that are often used to compare different businesses or different products within a company. The first of these terms is growth rates. Many PST questions will require you to calculate growth rates. They are a very useful tool to determine whether your company is going in the right direction and how its performance compares with previous years. You can calculate the growth rate of your volume, your revenues, your profits, or any other measure. Suppose you want to calculate the growth rate of sales between 2014 and 2015. Sales were equal to $100 million in 2014 and went up to $115 million in 2015. Then the formula for this growth rate is simply given by 115 minus 100 divided by 100, which is simply 15% growth rate. You should practice calculating growth rates, as these come up quite often in PST questions. The second important term is margins. A margin is basically any of the quantities we may be interested in divided by revenues. For example, you can define profit margin as being profits divided by revenues. Finally, you will sometimes see revenues or profits expressed per product or per employee. This is another convenient way to assess whether a particular product is doing well or to evaluate how the company could become more efficient. That's it for now. I hope you found this video helpful. You should now be well equipped to read comfortably through the business descriptions in the PSTs. You can focus on the key information you need to answer the questions quickly and accurately. Have a look at the bottom of our blog post, which also gives you some synonyms for the terms we just used, which can be useful to know. If you have any questions about these terms, feel free to leave us a comment below the article. You should also take a look at the rest of our website, where we share some useful tips to succeed at the PST.